Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. So today we are going to discuss a very important notification of the Reserve Bank of India regarding the customer protection from the fraudulent electronic banking transactions. Okay, and there are the compensation norms that have been laid down, the sharing norms that have been laid down, that who will bear this compensation that has to be paid to the customers. So we will discuss in detail that what is this customer protection norms that the RBI has released for the banks. Okay, who will be bearing the cost? The sender bank or the receiver bank, the beneficiary bank, which bank will bear the cost, as well as what is the percentage of the cost that the RBI will be bearing. So RBI to compensate digital fraud victims for losses up to rupees 50,000. So RBI is also going to do the compensation, or RBI is also going to bear a percentage of the compensation. So we will discuss that what is this electronic banking transactions, and what are the fraudulent electronic banking transactions, how the responsibility will be decided between the banks, the customer and the third party. So all of this we are going to discuss in today's session. The facts are very important from your RBI Grade B 2026 Phase 2 examination perspective, as well as this is also very important from the RBI Grade B 2027 examination perspective, because you need to understand that this is the change that the RBI has brought from the limited liability of the customers to the customer protection. So we will discuss that what is the change that has happened. Okay, so this is what we have to discuss. The second news article regarding the credit derivatives, this is a master action that the RBI has recently released. Now we started the discussion on the credit derivatives, but the last session we were not able to complete the discussion, so now we are going to complete the discussion. Okay, so first let's start with the compensation norms. First let's start with the customer protection, the first notification of the Reserve Bank of India, then we will continue with the credit derivatives and we will complete it in today's session. Okay, so now this PDF, the PDF of the session you will get in the Telegram channel. Okay, so the PDF of the session you will get in the Telegram channel of EduTap within 24 hours. So I hope first of all everything is fine. I'm clearly audible to all of you. Okay, so everything seems fine. Now the PDF of the session you will get in the Telegram channel within 24 hours. So now let's start with the first article, that is regarding your customer protection and the compensation norms to the customer. So Reserve Bank of India Responsible Business Conduct Amendment Directions 2026. So RBI Governor, that is Shri Shaktikanta Das, right now it is Sanjay Malhotra. So RBI Governor Sanjay Malhotra, through the Governor's statement in February 2026, announced that RBI would strengthen the customer protection in digital banking frauds. Okay, so remember first of all that with the Monetary Policy Committee statement that is released, there is the release of the statement on developmental and regulatory policy document. So with the MPC statement, there was the statement on developmental and regulatory policy document that was released, and in that and in the governor's statement it was announced that RBI would strengthen the customer protection in digital banking frauds. He stated, the Sanjay Malhotra, RBI governor, stated that RBI would revise the framework on limiting the customer liability in unauthorized electronic banking transactions. So the RBI governor stated that RBI would revise the framework on limiting customer liability in unauthorized electronic banking transactions, and also introduced a compensation mechanism for small value digital frauds. So now RBI has basically replaced the earlier framework on limiting the liability of the customers. So previously there was a framework that was limiting the responsibility, the liability, the obligation of the customers in the unauthorized electronic banking transactions, with a much broader framework on customer protection in fraudulent electronic banking transactions. So before there were the norms in which there was the limited liability of the customers, that the customers, they will have limiting liability, they will have certain limited liability, limited obligation in the unauthorized electronic banking transaction. Whatever losses happen, so the customers will have limited liability. Okay? Now, there is a broader framework that has been announced, that is the customer protection in fraudulent electronic banking transactions. So revised framework expands the scope of protection for the customers, and these directions, they are applicable from January 1st 2027. Okay, so applicability is, first of all, that these directions are applicable from January 1st, 2027, and they are applicable on the commercial bank, small finance bank, payment bank, local area bank, RRBs, urban and rural cooperative banks. So now, key highlights of the amendment direction. What is the change that has happened? From the limited liability, we have shifted towards the customer protections. What is the change? So first of all, alert for electronic banking transactions. A bank shall mandatorily send instant SMS alerts to its customers for all the electronic banking transactions of value more than 500 rupees. Okay, so this is the compulsory thing, that the bank shall mandatorily send instant SMS alerts to customers of all electronic banking transactions, whatever electronic banking transactions that are happening, whatever electronic transactions that are happening of value more than 500 rupees. First fact that you have to remember. Now, moving forward, first you have to understand that whose negligence or whose responsibility it is that the fraud happens. So first of all, negligence by a bank. So fraudulent electronic banking transaction might be possible because of some negligence by the bank. Such as not putting in place the mandated systems and procedures to ensure the safety and security of the electronic banking transactions, not sending the mandatory alerts for the electronic banking transactions, not sending the SMS alerts and such, not providing 24/7 channels for reporting of fraudulent electronic banking transactions or loss of debit or credit card, due to which the fraudulent transaction could not get reported in the timely manner, not acting diligently upon a customer notification. Customer has notified that the fraud has happened, but still the bank is not taking any step to block the card, or let's say the customer has notified that the card has been stolen, but still the bank is not blocking that card. So not acting diligently. If the bank is not acting diligently upon a customer notification regarding unauthorized electronic banking transaction or loss of debit or credit card, so if any of these things are happening, that means these are the negligence of the bank. System malfunction, if the bank system malfunctions or security breaches happen, due to that the money has been taken out of the customer account, on internal frauds leading to unauthorized electronic banking transaction, all of this comes under the negligence by the bank. Okay, now what is the negligence by the customer? First of all, the basic negligence by the customer is failing to exercise reasonable care in usage of credentials, such as PIN, sharing your PIN or password or OTP or other details, providing credentials for carrying out transactions, basically. Not notifying the bank promptly after finding out that a fraudulent transaction has happened from your account, or you have lost the debit or credit card. Not paying attention to a specific directed and clear warnings from the bank that a prospective transaction is likely a scam. So our bank is also taking multiple steps to notify that okay, this number can be scam and such. So not paying attention to specific directed warnings of the bank, downloading malicious apps or clicking on the links, failing to update her or his registered mobile number or email address with the bank in case of change. So your earlier number, it might be used, because after every 3 months or 4 months the telecom company changes, like they send the older numbers, like you have the old number that is no longer being used, so the telecom company can give this old number to some other person. Now if your old number is being used, like your own number is still being used by the bank, your old number is still with the bank, you can understand that you are not using it directly to make the calls, to make the SMS, to use the internet, but your old number is the number that is connected with your bank. Now this is being old number, telecom industry has given, or telecom company has given this old number to some other person. Now that person can access some of the transactions and such, or the OTP might be coming in that number, so that can be a problematic thing. Okay, so these are the negligence by a bank or the negligence by the customer. Now who will bear the responsibility? Let's see that. So processing of complaints and establishing. Okay, so processing of complaints and establishing liability in fraudulent electronic banking transactions. Okay, so how the complaints will be processed, how the liability will be decided. So first of all, it is the burden of proving customer liability. The burden of proving customer liability in complaints involving fraudulent EBT shall lie on the bank. So it is the burden of the bank, or it is the responsibility of the bank to prove the customer liability, that it is the negligence of customer that has led to to a fraudulent banking transaction, that has led to the fraudulent electronic banking transaction. So whose responsibility it is to prove the customer liability? It is the responsibility of the bank. So burden of proving customer liability in complaints involving fraudulent EBTs shall lie on the bank. The customer shall be entitled to zero liability. The customer shall be entitled to zero liability and reversal of the transaction in cases where the fraudulent EBT occurs due to the negligence or deficiency on the part of the bank. So if it is the responsibility of the bank, if it is because of the bank that the fraudulent electronic banking transaction could be done, so the bank should take the complete responsibility, or the bank has the maximum responsibility. There is zero liability with the customer. So whatever fraudulent electronic banking transaction, let's say it happened for 1 lakh, the bank will have to do the reversal of the transaction. The bank will have to bear the responsibility. Okay. So, customer shall entitled to zero liability and reversal of the transaction in cases the fraudulent EBT occurs due to the negligence and deficiency on part of the bank, irrespective of whether the transaction is reported by the customer or not. In cases where the fraudulent EBT occurs, due to negligence by the customer, he or she shall be liable for the loss incurred by him or her to the extent of loss not eligible for compensation. So, what is this compensation that we will discuss? But like excluding the compensation, let's say the loss happened for 100 rupees. Now 85 rupees is being compensated. Okay, if the electronic banking transaction in the there is a fraudulent electronic banking transaction that happened and the customer lost 100 rupees, so 85 rupees is being compensated, so the rest 25 rupees is the responsibility of the customer. That is the idea. Okay, in cases where a fraudulent electronic banking transaction occurs due to negligence by the customer, he or she shall be liable for the loss incurred by him or her to the extent of loss not eligible for compensation. Now let's say that here we have discussed the responsibility of the bank and the customer. In case that the fraudulent electronic banking transaction is happening because of the negligence of bank is bearing the responsibility. In case of customer, the customer has certain liability. Now what if there is a third party breach? Third party breach means a situation where the deficiency lies neither with the bank nor with the customer, but lies elsewhere in the system and includes deficiency on the part of the intermediary, such as the third party application provider, such as the Google Pay, Phone Pay. In their level, the breach has happened or the fraudulent activity has happened. So third party application providers such as Google Pay, Phone Pay, Paytm aggregators that have the responsibility of helping the merchants take the payments from the customers, or having the interface of payments between the merchant and the customer. Okay, so payment aggregator, payment gateway that allows the payment to happen from the customers to the merchant, telecom service provider. So basically, if there is bank does not have the responsibility, or bank has no negligence or deficiency, it is the intermediaries where the breach has happened. Okay, it is because of the intermediaries that the breach or the negligence has happened. So in this case, such breaches are outside the control of the bank and the customer. These breaches, they are outside the control of the bank and the customer, and the responsibility lies with the intermediary or other party in the system. Okay. So till now everything clear? So this is the third party breach. So basically, if a customer, see, if the third party breach has happened, it is the responsibility of the third party that the fraudulent electronic banking transaction could happen. So a customer shall be entitled to zero liability and reversal of the transaction in cases of third party breach. So customer will have zero liability, as well as the bank will have to reverse the transaction, give back the money to the customer, whatever fraudulent EBT happened, whatever fraud happened. So there is the reversal of transaction that is required to the customer. Okay. In case of third party breach, now in the case of third party breach, the customer will have zero liability. So, customer shall be entitled to zero liability and reversal of the transaction in cases of third-party breach where the customer reports the unauthorized fraudulent EBT to the bank within 5 calendar days from the date of its occurrence. So basically, when the bank negligence is happening, then the customer will have no responsibility, zero liability and no responsibility. If the customer is doing the negligence, so in this case, customer will have some responsibility that is not eligible for compensation. So customer will have some responsibility. A customer shall be entitled to zero liability in case third party breach has happened, but the customer has to inform about the unauthorized fraudulent EBT within 5 calendar days from the date of occurrence of such unauthorized fraudulent electronic banking transaction. If a customer files a complaint regarding fraudulent EBTs, the bank must examine the complaint, establish the liability. It is the liability of the bank, it is the liability of the customer, or it is the negligence of the third party, and issue its response to the customer within the timeline specified in the policy. So basically, the timeline cannot exceed 45 calendar days. So the bank, according to its internal policy, can decide the timeline that within 30 days we will respond to the customer, within 40 days we will respond to the customer. This timeline cannot exceed 45 calendar days from the date of receipt of the complaint by the customer in case of domestic fraudulent electronic banking transaction, and 60 days in case of cross-border fraudulent electronic bank transaction. So I hope this is clear that if a customer files a complaint that okay, this fraudulent electronic banking transaction has happened, so first of all the bank has to see that whose responsibility it is. It is the responsibility of the customer only, or it is the responsibility of the third party. So after examining, and this examination should finish, and the customer should be responded within 45 days in case of domestic fraudulent electronic banking transaction, and within 60 days in case of cross-border fraudulent electronic banking transaction. In case of a complaint arising out of fraudulent EBTs in a credit card, a bank shall provide shadow reversal. Shadow reversal is what? So customer reports fraudulent electronic banking transaction. Bank provides temporary or provisional credit. That means whatever, let's say from your credit card, 20,000 has been deducted from your credit card. 20,000 has been used, but you have not used it. Okay, there is some other party that was able to use your credit card, and there is a fraudulent electronic banking transaction has happened. So now customer reports this fraudulent EBT of 20,000. So bank provides temporary or provisional credit. This is known as shadow reversal. This is known as shadow reversal. Shadow reversal is basically that for the time being, the money is returned in the credit card. The money is returned so that there is no interest that is being charged. There is no extra like cost or charges that are being taken. There are no interest, no charges that are being taken on this 20,000 rupees, but you cannot use this 20,000 rupees until the case settles that actually the fraud has happened or not, or whose responsibility it was. So customer reports the fraudulent electronic banking transaction in case of the credit card. In case of the credit card, bank provides temporary or provisional credit. Shadow reversal happens, amount is credited, but the customer cannot use this amount. The amount is credited or amount is given back to the credit card, but you cannot use this credit card. Just the amount has been given so that you do not have to pay the interest, you do not have to pay the charges. So while the customer shall not be allowed to use such amount, he or she will not bear any additional burden of interest or charges. Okay, now there will be investigation that will happen, insurance claim that will happen, and after that the final decision will be taken that whose responsibility it is, the customers or the card network or the bank itself. So in case of a complaint arising of a fraudulent EBT in a credit card, a bank shall provide shadow reversal equivalent to the amount involved in the fraudulent EBT. So shadow reversal I've discussed with you. It is basically the temporary credit or the temporary return of the money to the customer. So this is the idea. So shadow reversal equivalent to the amount involved in the fraudulent EBT within 5 calendar days from the date of receipt of notification from the customer. Now this does not apply in case of payment banks. This particular provision does not apply. Shadow reversal does not apply in case of payment banks, because the payment banks cannot lend, they cannot provide the credit card. Okay. Now coming to the next part, compensation. So this is important. Till now any confusion? Basically we have discussed about the responsibility. We have discussed that like if the transaction is of 500, in this case if the transaction is more than 500, in this case SMS alerts have to be given, and we have discussed the shadow reversal that should happen within 5 days of receiving the complaint or receiving the information about the fraudulent EBT. We have discussed that within 45 days the customer should be responded to, and in case of domestic transactions, fraudulent EBT, in case of cross-border fraudulent EBT, 60 days are provided for replying to the customer. Now, compensation for small value fraudulent EBTs. If a bona fide victim, that is, if a genuine victim, being an individual, including sole proprietor, has filed a complaint involving total loss up to 50,000. So, if the total loss in the fraudulent EBT, is up to 50,000 due to fraudulent EBTs covered under the customer negligence category. In case of third party negligence, the customer has zero liability. In case of bank negligence, the customer has zero liability. But in case of customer negligence, the customer has the liability. The customer has certain liability. So basically, if a genuine victim, being an individual including the sole proprietor, that is the sole owner basically, that is also an individual, has filed a complaint involving total loss of up to 50,000 due to fraudulent EBTs covered under the customer negligence category, he or she shall be eligible for compensation that shall be 85% of the net loss amount. So if you have lost 1,000 rupees, 85% of that, that means 850 rupees will be returned to you, will be compensated to you because of your negligence if you have lost it. 10,000 rupees, let's say 10,000 rupees you have lost in the fraudulent electronic banking transaction, you have lost 10,000. So 85% of that, that means 8,500 rupees will be compensated to you. So the compensation shall be 85% of the net loss amount or 25,000, whichever is lower. So the limit of the compensation is 25,000, whichever is lower. Okay, this compensation shall be availed only once during the customer's lifetime because it is under the customer negligence. The RBI has clearly said that if it is the bank negligence, the bank will pay. The customer will have zero liability. If it is third parties negligence, then they will see it. The customer will have zero negligence. The customer will have zero liability. The customer will have zero liability. So if the customer has zero liability in case of bank negligence, third party negligence, but in case of customer negligence, the liability do lie with the customer also. So here it has been said that if it is the customer negligence, there is the customer liability, then there will be some compensation that will be provided, and the rest part is the customer liability out of the compensation. So if the complaint involving gross loss of up to 50,000 due to fraudulent EBTs covered under the customer negligence, in case of this, 85% is the compensation that will be given to the customer or 25,000, whichever is lower. The compensation can be availed only once during the lifetime of the customer, subject to the prescribed condition. The loss must be established as bona fide as per the bank's internal process that the loss was genuine. The victim has reported the fraudulent EBT on the National Cybercrime Reporting Portal or National Cybercrime Helpline and to the bank within 5 days from its occurrence. So within 5 days, that is the timeline that you have to remember. In case of joint accounts, only one of the account holders may submit a claim for the compensation. So if a complaint relates to fraudulent EBT involving a loss amount of less than 29,412, so if the loss amount is less than 29,412, the compensation of 85% is payable, because here the compensation is less than 25,000. Okay, so compensation of 85% will be payable. The compensation burden will fall, like in the case of domestic fraudulent EBT, the compensation burden will fall 65% on RBI, 10% on the customer's bank, and 10% on the beneficiary bank. While in case of cross-border fraudulent EBT, 65% will be the burden on the RBI and 20% on the customer bank. So this is the idea. Okay, so this is the idea. So if a customer relates, if a complaint relates to fraudulent EBT, if a complaint is regarding the fraudulent EBT involving a loss amount of less than 29,412, then the compensation of 85 is payable. But if the complaint relates to fraudulent EBT that is involving a loss amount of 29,412 or more, but up to 50,000. So if the loss amount is equal to or more than 29,412, but up to 50,000, in this case compensation of 25,000 is payable. Okay, so here compensation is of 25,000 is payable because 85%, if we see 85%, that will be more than 25,000. But more than 25,000 cannot be paid. More than 25,000 cannot be paid. So here remember this. Here remember this, that 85% or 85% or 25,000. Okay, compensation can be 85% or 25,000. So in case of 29,412, the compensation is 85%. While if the amount is more than or equal to 29,412, in this case compensation will be 25,000, because this is the maximum compensation that can be provided. RBI will provide 19,118. Customer bank will provide 2,941. Beneficiary bank will provide 2,941. Cross-border fraudulent transaction, RBI will provide the same amount, but customer bank will have to provide the joint amount. Okay, this is the idea. Now, if a customer submits the compensation application, so remember the numbers very clearly. Now, if a customer submits the compensation application, the customer bank must pay the compensation within 5 calendar days from the date of receiving the application. The customer bank shall seek reimbursement of the amount receivable from the RBI and the beneficiary bank on the quarterly basis. So basically, if a customer submits the compensation application, so if a customer is submitting the compensation application agreeing to its negligence, the customer bank must pay the compensation within 5 calendar days from the date of receiving the application. The customer shall take the reimbursement from the RBI and the beneficiary bank on a quarterly basis. The application of reimbursement shall be submitted within 30 calendar days from the end of the respective quarter. The compensation shall be payable for losses incurred on fraudulent EBTs occurring up to 1 year from the effective date of these directions. So these directions are effective from 1st January 2027. So for 1 year, this compensation scheme or this compensation will be provided. Okay, or the compensation will be payable for losses that have been incurred for fraudulent EBTs occurring up to 1 year from the effective date of these directions. A bank shall retain the records related to the compensation that has been paid and the amount that has been claimed, and the records have to be maintained for 2 years from the date of closure of the compensation mechanism. That is the idea. So here the infographics are being provided to you so that you can remember the data, you can remember the idea. Okay, now here through these infographics you can focus on the data. Here compensation, you can remember that the compensation can be 85% of the net loss or 25,000, whichever is lower. If the amount is 29,412, if the amount is less than 29,412, then the if the loss amount is less than 29,412, then the compensation will be 85%. The compensation will be 85%. If the loss is 29,412 up to 50,000, then the compensation will be 25,000. This is the idea. Chalo. Now coming to the next direction, coming to the next article. Any confusion anyone has till now? Any confusion? Chalo. No confusion. Then going forward with the next direction. So see, we have discussed about the credit derivatives in the previous session. We have discussed about the CDS, the credit default swap. We have discussed about the total return swap. We have discussed about the index CDS, the credit default swap for the index. So all of this we have discussed. But because the session had to be stopped in the middle because of the technical issue, so we were not able to complete this. So let's complete it now. Now for the credit derivatives in the OTC market. So if the credit derivatives are in the OTC market, if the credit derivatives are purchased on the OTC market, credit derivatives are basically, they are providing the protection to the bondholders. They are providing the protection to the bondholders. So direction on credit derivatives in the OTC market. First of all, if you are not aware about the credit default swap, if you are not aware about the total return swap and such, first you have to see the previous session of the Finance 360, then only you will be able to understand this, because till this point we had discussed everything in the Finance 360 the previous session. Okay, so direction on credit derivatives in the OTC market. So market makers, we discussed about the market makers that can buy and sell the credit derivative. schedule commercial bank except small finance bank, payment bank, local area bank, regional rural bank. So schedule commercial bank, standalone primary dealers, NBFC upper layer and middle layer. So and the Exim, NABARD, NABFED, SIDBI, all of these, NHB, all of these are the market makers that can buy and sell the credit derivative. Now, mistakenly, I said that they can buy and sell the credit derivative in OTC and the exchanges also. No, the market makers, this is for the OTC. This is for the OTC. So the who can act as market makers? These entities can act as market maker in the OTC market for both the credit default swap and the total return swap. Okay. So for both the instruments, I wanted to say for both the instruments in the OTC market. So these are the market makers that can buy and sell the credit default swap. They can buy and sell the total return swap in the OTC market, okay, because the exchanges, the stock exchanges, they have the different working conditions, and they are regulated by SEBI. So this is the idea. So RBI has said that these are the market makers, the banks, NBFCs, all India financial institution. These are the market makers that can buy and sell the credit default swap. They can buy and sell the total return swap in the OTC market. Now, next we were discussing the participants in the credit derivative in the over-the-counter market. So, in the credit derivative, the protection buyers and sellers for credit default swap. So, who are the buyers and sellers in the credit default swaps? Who are resident retail user other than individual shall be allowed to buy the credit default swap for the hedging purposes only, okay, for reducing the risk. You can buy the credit default swap for reducing the risk. A non-retail user shall be allowed to buy protection, shall be allowed to buy the credit default swap without any restriction on the hedging or for speculation purposes. The following non-retail users shall be eligible to act as protection sellers. So basically, the market makers are there in the credit default swap. The market makers are there in the credit default swap that can buy and sell the credit default swap, as well as there are the non-retail users that shall be eligible to act as protection sellers that are allowed to act as the credit default swap sellers. So the following non-retail users shall be eligible to act as sellers of the credit default swap. So they can purchase the credit default swap, they can sell the credit default swap. So insurance company, pension fund, mutual fund, AIF, FPI registered with the SEBI. Now when there is the FPI, foreign portfolio investor, that is involved, so foreign portfolio investors, they are allowed to participate in the CDS contracts. In the credit default swap contracts, they are allowed to sell the credit default swap protection. So the total notional amount of credit default swap protection that can be sold by all FPIs shall be subject to a limit of 5% of the outstanding stock of corporate bonds. So let's say the total outstanding stock of corporate bonds is 1000 crore. So the limit of the CDS protection, the credit default swap that can be sold, or the CDS protection that can be provided, is 5% of the total amount of credit default swap that is outstanding, of the total amount of corporate bond that is outstanding. So I hope this is clear. First of all, that let's say the total amount of corporate bond that is outstanding is 1000 crore that is present in the financial market. The credit default swap that can be provided by the FPI is 5%. It's 5% of the outstanding value of the corporate bond. So this is the idea that the FPIs, they are allowed to participate in the credit default swap. They are allowed to sell the credit default swap contracts, but the total notional amount of the credit default swap that can be sold by the FPIs, it is subject to a limit of 5% of the outstanding stock of corporate bonds. So once this limit is fully used, the FPIs cannot sell further CDS protection. So that is the idea. So in case of the CDS, TRS, these are the market makers. Or there should be the central counterparty, that should be one party, the other party can be users. Okay, so at least one party should be market maker or the central counterparty. The users can be retail users for the credit default swap and the total return swap, or the users can be non-retail users. So it can be retail users or the non-retail users. So they can use this credit default swap and the total return swap. Now in the case of credit default swap, resident retail user can buy the credit default swap, non-retail user can buy the credit default swap. In the case of who can provide the credit default swap. So credit default swap can be provided by the market makers that we have discussed initially in the OTC market, as well as the CDS can be sold. The CDS can be provided by these entities. Okay. Now the FPI, if it is providing the CDS, if it is selling the credit default swap, the notional amount of the CDS protection that can be sold by the FPI is 5% of the outstanding stock of corporate bonds. This is the idea. Now a market maker shall not offer CDS contracts to an individual. So a market maker shall not offer. So even if we are talking about the retail users, they are the, let's say, resident companies with less than 500 crore of the net worth and such. So these are the non-retail users. Resident company with minimum net worth of 500 crore or minimum turnover of 1000 crore. So they are the non-retail user. Okay, if they have the minimum net worth of 500 crore and more than that, minimum net worth of 1000 crore and more than that. What if they have the net worth of 100 crores only, or the turnover of 50 crores only? So that means they are not the non-retail users, they are the retail users then. They are the retail users then, because they are very small companies. They are the retail users. They are not the non-retail users. For the non-retail users, there are the criteria. Okay, the big companies and the financial institutions, they can be the non-retail users. So basically individuals in the retail users category, the individuals, they are not allowed for the credit default swap in the OTC market. This is for the OTC market. So I hope this is very much clear. Any confusion, anyone? So in the OTC market, the credit default swap can be sold to the resident retail user other than the individual and the non-retail user. Now these are eligible to act as protection sellers. And CDS contracts sold by the FPIs, there is limit of 5%. Okay. So market maker shall not offer CDS contracts to an individual. Market maker shall not offer a CDS contract to an FPI where the reference obligation, that means the bond against which the protection is being provided or the index includes a money market debt instrument or a debt instrument with residual maturity less than 1 year, or bond that has options exercisable within 1 year. So basically a market maker that we have discussed. Who are the market makers? These are the market makers in the OTC market. These are the market makers for the credit default swap and for the total return swap. These are the market makers. So market makers, they are not allowed to offer a credit default swap to a FPI if the bond, that is the reference obligation, against which the credit protection is being provided. So basically, let's say the FPI has purchased the bonds. They have purchased a bond and they have invested in the bond. Now they are afraid that what if the bond, the issuer defaults? What if the issuer that has issued the bond, what if the company that has issued the bond defaults? So FPI want to have the credit default swap, that if the issuer defaults, if the company defaults, then the other party has to pay for the default amount. Okay, so this is the idea of the credit default swap. So basically it has been clearly said that a market maker cannot offer the CDS to a FPI if the bond, if the reference obligation or the index maturity is less than 1 year. So if the bond have the maturity of less than 1 year, or the bond has the options, that is they can mature within 1 year. So in this case, the CDS should not be provided. Okay, so that is the idea, that CDS cannot be provided to the FPI. So CDS, the credit default swap, cannot be provided to the FPI in case the residual maturity of the reference obligation, in case the residual maturity of the bond, that is the underlying, is less than 1 year. Now participants in the total return swap. So a market maker may offer a TRS contract to the resident retail user other than the individual, as well as to the resident non-retail user without any restriction. A market maker may offer the TRS contract, the total return swap contract, to a person outside India also. A market maker may offer a TRS contract to a person resident outside India, including an FPI, for purpose of hedging, for reducing the risk. Market maker can offer TRS to a foreign resident or FPI as total return receiver only when the foreign resident FPI pays the full value of the underlying asset. So basically in the total return swap, there are the total return payer and the total return receiver. Okay, total return receiver, there are the total return payer and the total return receiver. So if the person resident outside India and the FPI, the person resident outside India, including the FPI, they can purchase the total return swap. They can purchase the total return swap. Okay. But the market maker can only provide the total return swap to the foreign resident to the FPI as total return receiver. They cannot be total return payer. Okay. So a market maker can offer the TRS to a foreign resident FPI as total return receiver only when the foreign resident or FPI pays the full value of the underlying asset upfront. So they cannot be the total return payer in this category. So basically, see in the TRS, generally the person resident outside India or the FPI, they can be the total return payer because they have purchased the bond. Now they do not want to take the risk related to the bond, so they are paying the returns related to the bond. They are paying the returns, or they are transferring the returns related to the bond to some other party, that is the total return receiver. Now the PROI or the FPI, they can be the total return payer. They can be the total return payer without any conditions. Without any conditions, they can be the total return payer. They are getting the fixed or the floating predetermined interest rate. They are getting the fixed or floating predetermined interest rate, and they are sending the returns to the total return receiver. Now, if they want to become the total return receiver, so that PROI, the person resident outside India, the FPI, they can be the total return payer. But in case they want to become the total return receiver, in this case, they need to provide the full value of the underlying asset. They need to provide the full value of the bond, because they do not own the bond here. In the case of total return receiver, they do not own the bond. In the total return receiver, they are receiving the returns from the bond that is held by the total return payer. So in case the bond is held by the total return payer, that is some other entity, and the FPI or the PROI, they want to become the total return receiver, they need to pay the full value of the underlying asset upfront. So that is the idea. Okay. So I hope this is very much clear that the TRS can be offered to the resident retail user, non-resident retail user, person resident outside India, and the TRS contract is provided where the person resident outside India or the FPI, they can become the total return payer without any. They can become the total return payer without any conditions. Okay? But if they want to become the total return receiver, they need to fulfill the condition that they have to pay full value of the underlying asset. Market maker can offer TRS to foreign residents or FPI. So market maker can offer TRS to foreign residents or FPIs either directly from India or indirectly through its overseas or IFSC group entities, but only as per the conditions that the overseas entity, they are eligible to deal with such products. The wholly owned subsidiary or joint venture of the market maker incorporated in India can undertake such transactions provided the wholly owned subsidiary or joint venture is a banking entity. So market makers, we have discussed scheduled commercial bank, the standalone primary dealers, they are the market makers. Their wholly owned subsidiary or joint venture can provide such products to the foreign portfolio investors or to the PROI. Okay? Foreign portfolio investor cannot be offered TRS on debt instruments that are short-term, close to maturity, or can be repaid early within 1 year. The same thing, the credit default swap could not be given to the foreign portfolio investors if the debt instruments, the underlying debt instruments, were of short term. Similarly, foreign portfolio investors cannot be offered TRS also if the debt instruments are short term. A market maker shall not offer a TRS contract to an individual. The rest norms are same. Now, reference entities, reference obligation means the specific debt instrument whose credit risk is being covered in a CDS contract, in a credit default swap contract. Reference asset means the underlying asset whose total return is exchanged in a TRS contract. The following debt instruments issued in India shall be eligible to be reference obligation: money market debt instruments, rated INR corporate bonds and debentures, unrated INR corporate bonds and debentures issued by the special purpose vehicle, and that is a kind of subsidiary of the infrastructure companies. So bonds with call or put options shall be eligible to be reference obligation, reference assets. Instruments not permitted as reference obligations. So these are the asset-backed securities, mortgage-backed securities, structured obligation, guaranteed bonds. So if they are already backed, if the bonds already have some backing, so they do not need the credit default swap or total return swap and such. Okay. Now, other operational directions: market participants shall not enter into CDS or TRS transaction if the reference entity is a related party to either counterparty. So, market participants, that is a market maker and the user, they cannot enter into CDS or TRS transaction if the reference entity, that is the bond that has been issued by XYZ, if the bond, issuer, if the bond issuer is a related party, so the market participants shall not enter into CDS or TRS. So if the market maker, the issuer of the bond is the related party of the market maker, or if the issuer of the bond is the related party of the user, then there can be no protection, or there can be no CDS or TRS. Okay. However, two or more government-related entities shall not be deemed as related parties for the purpose of these directions. Credit derivative contracts shall be settled either directly between two parties or through the RBI-approved clearing and settlement system. Credit derivative contracts can be cash settled. That means only the profit and loss is being settled, or physically settled, where the bond is being given and the money is being transferred. Okay. So this is the idea. Now the procedure for cash settlement and auction settlement of CDS. So auction settlement can also happen where the settlement, let's say the default has happened by the issuer, bond issuer. Now how much money should be given to the bondholder? So it depends upon that what is the current market conditions, as well as how much default will actually happen, how much money can be retrieved from this bond issuer. So the auction settlement is basically that the conditions will be saying that, okay, how much is the default has happened after taking into account that how much the bond issuer can pay. So bond issuer, let's say, has taken 100 crores, but the bond issuer has the capacity to pay 60 crores. So the default will be of 40 crore. So auction settlement, basically, as per the market conditions, it is seen that how much the issuer can pay, how much will be retrieved, and how much is the actual default. Okay. So only the default amount will be settled. So cash settlement, auction settlement, only the default amounts is settled. While in the physical settled, the bond has to be sent. The bond has to be transferred. Okay. Any floating interest rate under the TRS shall be a benchmark published by the Financial Benchmark Administrator. So in the TRS, the total return payer is paying the bond returns, or the bond whatever returns are there from the bond, to the total return receiver, and the total return receiver is giving a predetermined floating interest rate or the fixed interest rate. The floating interest rate should depend upon certain benchmark that is published by the Financial Benchmark Administrator. The settlement basis and market conventions for credit derivative contracts shall be specified by the FIMDA in consultation with the market participants and based on international best practices. Okay. So how the settlement will happen, the market conventions, they are going to be decided by the FIMDA. The market maker shall report all OTC derivative transactions within 30 minutes of the transaction to the trade repository of the CCIL. So market makers shall report all OTC credit derivative transactions within 30 minutes of the transaction. Market maker shall report all amendments, unwinding, novation, if the party has changed, the other party has changed, and such settlement transactions, and any credit substitution to the repository of CCIL. Now FIMDA shall set up a credit derivatives determinants committee. So it is the FIMDA that will set up the credit derivative determinants committee, consisting of market makers and users in credit derivatives as voting members to decide the rules and regulations. The committee may also include central counterparties as observer members. The decisions of the credit derivatives determination committee shall be binding on the market participants. Now, so credit default swap on exchanges. Now coming to the directions on stock exchange traded credit derivatives. Now, before this, all the directions were for the OTC. Now, coming to the stock exchange, if the credit derivatives, the CDS, the TRS, if it is being provided on the exchanges, on the stock exchanges, so basically, so far the discussion mainly covered OTC credit derivatives. Now, the credit default swap on exchanges, they will follow the exchange norms. Exchanges may offer standardized single name CDS contracts on credit indices with guaranteed settlement. Exchanges shall obtain prior approval. The NSE, BSE shall obtain prior approval of the RBI for product design, changes in product design, eligible participants, other details of the CDS contracts. Okay, so participants who are retail users shall undertake transactions in exchange traded CDS only for hedging purposes. Exchanges shall report the gross notional amount of protection sold by FPIs to CCIL on a daily basis. So basically, in the OTC market, the CCIL, the trade repository of the CCIL should be like the market makers, they have to report to the trade repository of CCIL within 30 minutes of the transaction. Exchanges should also report the gross notional amount of protection sold by FPIs to CCIL on a daily basis by the end of the day or on intraday basis. Now, CCIL shall publish the notional value of credit derivative contracts outstanding for each debt instrument on a daily basis. So, CCIL shall publish the notional value of credit derivative contracts that have been signed on the daily basis. So here through the infographic, you can focus on the main points. You can focus on the overall idea. The infographics are provided for you to remember the key points. Okay. So here the eligible transactions, CDS and TRS, general condition, a market maker, at least one party should be a market maker or RBI authorized central counterparty, who can be the retail users, who can be the non-retail users. So one party should be market maker in the OTC credit derivative transaction. One party should be the market maker or the RBI authorized central counterparty or RBI authorized central counterparty, and the other party will be the user. It can be the retail user or non-retail users. Who are the non-retail users? That is the list that has been given. Now, the credit default swap in the OTC market. So, prediction buyers, prediction sellers. Who can be the prediction sellers? Who can be the prediction buyers? So, that has been laid down. So, FPI conditions, that has been also laid down, that FPI limit for the CDS prediction sold, the FPI limit is 5%. Okay, chalo. So here this is provided for your revision, and you can read this to have the clarity. Now let's see the questions. Any confusion till now? I hope everything is clear. Chalo. If there is no confusion, let's move forward then. Now coming to the questions, these are some general directions. When a user enters into a credit derivative contract for hedging, the market maker must check that the user is actually facing the risk being hedged. The user must have exposure to the reference asset, that is the bond, to be eligible to get the credit derivative. In case of an index-based credit derivative, the user must have exposure to one or more debt instruments that are part of the index. The user cannot buy credit protection for an amount higher than the value of the asset held by them. So if the bond value is 1000 crore, the protection can be for this amount only, right? Not more than this. The tenure of the credit derivative contract cannot go beyond the maturity. If the bond is maturing within 5 years, so for the credit derivative also, for the protection also, that will mature within 5 years, that will mature after 5 years. If the user later sells the asset or no longer has the underlying exposure, the hedge is no longer valid. Okay, so tenure of the credit derivative contract cannot go beyond the maturity of the asset. If the bond has the maturity of 5 years, so the credit derivative will also have the maturity of 5 years. Now in the phase 2 of the RBI grade B 2026 examination, such kind of question can come, that a paragraph is given about the credit derivatives directions 2026, and you have to answer the questions. Which one of the following entities is not eligible to act as a market maker in credit derivatives under the RBI credit derivative direction 2026? So which of these is not eligible to act as market maker? I hope you will be easily able to answer this question. Which one of the, so basically in the OTC market, which of these are not eligible to be the market maker? Which one of the following statements regarding the credit derivatives determination committee is correct? It is set up by RBI, consists of RBI officials. It is constituted by CCIL and its decisions are advisory in nature for the credit derivatives. It is set up by FIMDA and consists of market makers and users as voting members. It is constituted by a SEBI to regulate exchange traded CDS only. It consists exclusively of banks and insurance companies. Now coming to the last question, which one of the following entities cannot be classified as a non-retail user by market maker? So who are the non-retail users? The insurance companies, the pension fund, the alternative investment fund, the resident companies that have the net worth of minimum 500 crores and the minimum turnover of 1000 crores. So see the statements and try to understand and try to answer that which of these cannot be classified as a non-retail user by a market maker. Okay, chalo, this is it. So do see, you will get the PDF of the session in the Telegram channel, okay, of EduTap. So this PDF will be provided to you within 24 hours. So this is it for today. Now, ma'am, I have earlier requested to kindly provide a full 5-hour 30-minute mock for phase 2. I will discuss this with the team because full length mock test will mean that you want finance management, ESI and English descriptive. So it needs the whole team. I will share your request with the team, with the support team. They will see that if it is possible, and yes, I will share your request with the team. The team is the one that will take the final decision. Okay. So this is it. So this is it for today. I hope you understood everything. If there is any confusion, you can share your query in the comment section below. Okay. And for the second article for the credit derivatives, first see the previous session, then you will be able to understand this. So this is it. Thank you everyone. Thank you for